You had an 132R week.
Uh,
Okay.
you been?
Been all right, been busy, busy, trying to get sorted. What about you?
Yeah, same man. Hella busy. Work and other things, and then got a flat to look for again because my landlord is moving us all out. So AIDS.
We won't say too much because the call's being recorded, but we'll have a
Yeah. Oh
Mm.
yes.
okay. Yeah, exactly. Okay, right. Let's get started. See how this week's gonna go. Let me share my screen. Let me just share screen one. Share that. So let me know if you guys can see.
Yep.
Yeah, I can see it.
Looks good.
I must test this. Excel is working. The big one is working. Do a little test. Make sure this doesn't crash my computer again. Right. And then the big one, the new one, the one,
Mm, look at that.
one that kills computers. This is the one I'm concerned with. Because it's different when you're running it by yourself than when you're running it with Zoom.
Mm.
Right. Okay. So far, so good. Click on EuroUSD. How long is it going to take to run? If you try to run this on a normal computer, you definitely break your computer and have to buy a new one.
Yeah,
I
you
mean,
have like a lot of tabs and things open, no?
no, not even.
Or
It's
is
just
it are you just meaning like the actual
the
Excel sheet that
actual,
you've
yeah,
made?
the actual file kills computers. Is this file when I built it the first time with like a tenth of the data broke my first computer,
Jesus.
so I had to buy another one. It should run. It was run in previous calls, but it's not run. Hmm. Okay. Well, as soon as it gets to EuroUSD, which it should, because it's basically saying it's there, then we'll start the call. Well, we'll let people in.
Hmm.
Oh, geez, what the? Okay, this is not a good sign. Good thing we tested it. Okay, it's updated. Cool, fine. That was a ball like. All right, whatever. Let's go with it. All right.
Ready to let them in?
Yep.
Okay. There you go.
Make sure everyone gets in. Everyone can hear me. Sorry, we had technical difficulties. My model almost killed my computer again. Cool. Make sure we get everyone in, and then we can start. Get the meeting agenda to my left. Sure it's organized. Price action recap, data analytics versus price action, playbook part one, and mindset and psychology. Right. Okay. Let's get the questions section up as well so I can see what people are asking. Okay, we've got a message from Lolo. That was answered, so we can archive that. Lunch money question. Okay, Jewel has a question. There's not really many questions. Just one question to answer about how to use the risk reward tool, which we'll do, and then one question about lunch money. Okay, right. So I'll address those at the end, or I'll end up addressing them in the call. All right. So let's start. So what I wanted to touch on, now that everyone's here and can hear me loud and clear, just making sure. Looks like it's cool. Okay, so let's start. So one of the things I wanted to touch on is I wanted to talk about data versus price action, but also some of the changes that are going to be happening on the site regarding the data, because I've spent like the last week adding data for other pairs for the people that don't trade just GU and EU. So we're gonna work. So I've built the models to do all the data analysis for all of the JPY pairs, all of the um, all of the JPY pairs, all of the indices, all of the USD pairs in terms of GU, EU, and AU, and yeah, that's it. So what I wanted to do is just show you that, as well as I've also made some modifications to one of the data tables regarding the session data, because I had a really good call with Michael, who's in our community, Michael S. Don't know if he's in here or not, but he gave the suggestion, which was relative to the hour that you're looking to enter, you want to be able to see what the probability is at that given hour. So I rebuilt all the models to have that included, which I'm going to show you how to use it in today's Learn Liquidity session before it gets uploaded to the site early next week. I'm hoping. It's a lot of work to do, but we're working hard in the background to get it done. And then we'll touch upon how to build a playbook part one, where I'll show you like the basics of like what a playbook is and why it's useful and what you need to do. Because I know it's an extensive topic, we will split it into two parts. So I'll go over like the basics of a playbook today. Then I'll show you my playbook in detail next week, because it's too much to do in one session. And I want to make sure we cover this week's price action properly, answer questions and all sorts of stuff first. But it is something that I know is important in my trading, so I want to make sure that you guys have it in your trading also, but I want to make sure I take my time and do it properly. I don't want to rush it. So we'll do as much as we can today, but I do know the playbook series will be more than just today. We'll do it again in detail next week. So first things first, let me just show you all the data first, in terms of what I've been working on this week and what's to come. And then I'll show you application of it, and then we'll go through this week's price action, if that's cool with everybody. Can we get some feedback in the chat so I know? Let's see. Okay, cool. All right, so let me show you the new data. So first things first, I've updated all of the data for 2023. So now we have, let's put this down. Don't really need all this. But now we have it for 10 pairs. So I just need to update this for AUD JPY pairs, but we have it for all USD pairs, gold, NAS, US30, and S&P 500. And the trend basically is the same for all of them. Monday, Tuesday, the high, Thursday, Friday, the low for all pairs. That's the general consensus. It's a thing for every single pair. So it's an algorithmic cycle, basically. That's not even pair dependent. It's just how the algorithm works. So the first conclusion that I thought is true. So I mean, once you know this, you don't really need to relearn it. It's like, okay, you know that the high of the week is most likely to be Monday, Tuesday. So when you add these two percentages together, 66% over how many years? On NAS, you only have 10 years of data, or 11. And then for gold, same thing. Add these two percentages together, that tells you the percentage of the high of the week. So you can see that at 74%. The low of the week, 72%. Bullish week, you're looking for what? The low of the week. Add these two percentages together, 73%. Looking for the high of the week as your target, 75%. So the reason why I'm going through it like this and actually showing you the actual models, because it's one thing to see the pictures, but now you can actually see the models in action. So you can see, I don't know, get more confidence in what you're basing your decisions on. Like the models are real, as you can see. So there's that aspect of the data. So weekly cycle data has been updated for 2023 up until last week. So this doesn't really need to be updated again for a while. So maybe by midpoint 2024 we'll update it, but right now it's as up to date as it could possibly be. Then another change that I've done, I've also updated all of the weekly pip range data, but I've got it for the US pairs now, the indices, but I've also updated it for updated it for 2023 also. So that's how we're able to see now up until November, as well as I've also extended the date range so we can see 10 years of data compared to what we had before, which was 8. It could do more, but given how big the table is already, I don't think it's necessary. 10 years of data is more than enough. So yeah, well, actually it's 11 years, but that's besides the point. So yeah, we have this now up to date as well. That will also be going live on the site. One of the things that, on the basis of Michael's suggestion, also that I changed the monthly extreme analysis as well. So one of the things that I did was I made it cumulative on the way down, because ultimately it's a lot easier to understand when you're looking at it and using it to know that, okay, for example, let's say I was on Euro USD. By day number 7, I know if bearish, there is an 83% chance that the monthly high has been printed. Or if I'm all the way down to, let's say, what day are we? Day 16. Now I know there's an 100% chance that in November, that the monthly extreme over the last 17, 16 years has been printed at this point. And same thing for the bullish scenario. So either way, the monthly extreme of EURUSD in November over the last 17 years by now should have been printed based on history. So whatever extremes you're seeing on the monthly candle, depending on bias, has been printed. So if we're bearish, the high has been printed at this point statistically, or if we're bullish, the low has been printed at this point statistically. So the real conundrum is, okay, what is the bias? But regardless, the bias in line with the extreme, based on history, has definitely been printed at this point. So now, if you, let's say, are bearish and you can see the monthly high at this point, then you would say, okay, I can short and I just need to cover that. And based on history, there's a 100% chance I will not get stopped out if my bias is correct. And vice versa if bullish. So like, this is a lot easier to understand compared to like when it was every single day was a percentage, then you had to manually add it up. Now it's like far more user-friendly. So then this is a change that's going to be going live on the site also. We might touch it based on like some applications of this in the call as well, but I just wanted to show you what the change was and the data. And this also has been done for all the pairs, as you can see. So that's a change. Then for the people that are super curious, so we're just like, okay, if we could figure out where the high of the month is by day, then surely we could figure out where the high of the year is. Yes, we have the data, but use it with a pinch of salt because it's only 17 years, so there's not that many data points. But based on 17 years, 4 of which were bullish, 13 of which were bearish for EU, we at least know if you wanted to, let's say, get the high of the year, most likely it's a swing trader. This is the reason why I'm mentioning this stuff. Or this is more position trading than swing trading at this point because you're looking to hold for like months. But in theory, if we knew EU was going to be bearish, then we'd be loading up positions in January and February based on the statistics because it's the most likely place that we're going to find the yearly high. And we'd be looking to get out in November and any month from September onwards because we know the percentage chance of the yearly low. Why is my computer doing this? Okay. Technical difficulties. Hopefully this sorts itself out in a minute. That's not good. This would be the perfect time to put an advert on the call. Oh no. You can't make this up. Okay. What's that English saying they say? Computer says no. Sometimes you have to laugh and sometimes you cry. What is going on here? Okay. This might have been the final straw for my computer. Oh, come on. Don't. Okay, maybe I shouldn't have done that. Okay, well, we're back, people, we're back. 32 gig, the biggest you can get. Anyway, all right, so it's a super file, that's why this happens. Anyway, yeah, like I was saying, the percentage chance of you finding the high. So same principle as when you have the weekly, you add them up, right? So if we wanted to have the yearly high, we'd add them up. So the percentage chance of you finding the high in January or February is 53.85%. So if you're a position trader, this is where you'd want to get in, ideally. And then if you are looking to get out, you're looking to get out sometime between September and December. You can add these up, and there's a 70% chance the low will be in one of these months. But you can see December and October are the most likely places to find the yearly low, at least based on the last 17 years, given the fact that 13 of the 17 were bearish. And you can see the same thing for GU. December stands out by far in GU as the month to get out. And it's the same principle. January is a good month to find the high, and vice versa. So we have that data for anybody who's in Project Lowdown who is a position trader. We have that data for you as well. Then the main event, the thing that everyone really wants to see, or at least Michael, I know for a fact wants to see, is this. So now we have this data, but we have it with a cumulative column. So I'm going to explain with some examples now how this works. And I also have it for the cumulative, and I also have it for the session data. So this just makes it easier and just like visualizes what I was saying. Like when we, let's say, talk about lowdown liquidity and we know that Asia sweeps London, then we know the probability of finding, let's say, the high of the day in Asia or London, we already know is 80%. So this just visualizes it. It makes it easier for us, basically. And I have that by hour also. And I will give some examples now on how to use this. And then the last data change that we have is pip availability is updated up until 2023 November. So this number is more accurate than ever before. And we now have it for gold, and we will have it for the JPY pairs as well for next week. So that covers all the data updates that I've been working on. Oh, and we have one more, which I'll show you also now, before I forget. We also have this. Is this it? Yeah, okay. I have also done some data behind, where is it? Fibonacci. Fibonacci. Where is the Fibonacci stuff? I literally had it open a second ago. Okay. Okay, let me reopen it. I think it's gone. We have some statistics on the Fibonacci. There we are. So this was manual and painful, and I already knew the stats before, but I wanted to make sure that you guys have reference because I can't just assume you know what's in my head. So I tested the Fibonacci because a lot of the questions I was always getting, regardless of the fact that, this part is somewhat discretionary where I know I'm willing to enter anywhere between the 50 and the 78.6. But I did do a study and back testing on 100 retracements on each of the pairs that I trade. And I saw that the 61.8 pretty much across the board is the most common that I see in terms of how I trade the Fibonacci. And more importantly, I wanted to prove what I already knew, which was my magic level, which is the 89.6, doesn't get hit often at all. There's only a 3% chance it will get hit and it will still be a retracement. Therefore, it is a nice refined stop level for any one of these levels, because then you don't have to cover the swing high and you can put it here and get more up. So this is proof that it works based on statistics, not feeling. So we have this data now that will also be uploaded on the site. So there's that too. So far, so good. Do you want to get some feeling of the chat? If the high of the day is printed at 130, do you look at the 1 o'clock hour or you look at the 1 o'clock hour? You always look at the hour that's associated with it. To answer Adam's question real quick. So I'm going to show some examples of that now. I think Adam was one of the lucky few that got to see it early as well. Okay, so recap, we basically have data for everything, and we have data that proves the Fibonacci now. So the stuff that I'm going to focus on for next week is I'm going to show the lunch money statistics as well. I'll touch upon lunch money more and explain more about why that works in today's call. We'll touch upon the Fibonacci stuff as well, since Saj wants to know some stuff too. And yeah, just a general weekly price recap stuff and how to use this new model, like I talked about here. That'll be the priority of this call. And then if we have time, we'll touch upon the playbook a bit. But I don't want to rush the playbook because, like I say, it's super important. We can't rush it. Like, it's probably one of the most important things in your trading. So if anything, it deserves like a focused call just on that. Right? So let's get started. So let's explain how to use this data first, because I think it's important. So let me find an example. So, okay. Let's make this max size. So top-down analysis as always. So what do we have on the weekly or even the monthly time frame? So on the weekly, we have a liquidity POI here that swept before breaking structure. So I classify this as a breaking structure. So this is a sweep before the break. It's a significant sweep. So this is a liquidity POI for me. So I'm looking to potentially short from here. if I have a bearish monthly bias. When I look at the monthly, given the fact that you've had a demand reaction here and we were chaining on the way up, this was a failure of two key points of demand on the monthly level. So for me, I was under the impression that, okay, maybe we form a monthly, a monthly top wick, and then the rest of the month we go down and we go towards this imbalance as the drawn price. So that's why I have a bearish bias, because I don't see much inefficiency up here to justify why we would come all the way up. So for me, I mean, you have this, but is this significant enough to come all the way up for that? In my opinion, no. So my monthly bias was to go short, given the fact that this was pretty close. The macro sentiment, if they were to increase the interest rates, even though they're a bit dovish on it at the moment, but if they were, then it would lead to an increase in demand and therefore we go down. DXY, same story. I was anticipating this to get filled, so I was bullish. So this was why, at least from a high time frame perspective, I was looking to potentially short the pound pairs because I was expecting us to go bullish for this month. Clearly, that is not what's happening, so we have to adapt. But that was my bias at the time. So, with regards to the weekly now, what do we see? Not much, to be honest. So the liquidity POI that I drew, which I go on GU and EU, because these are the two pairs I trade. So you can see it's the weekly top wick. And then if I go down and see this as, okay, where is another structure break? It's the same thing. That's a structure break. That's the CPB. So let me do that again for EU as well so you can see. But let me just focus on EU for now. But because I trade them both, you can see I use the DXY to come up with my decision making for what I want to do on the pound and the euro. So that's the CPB, that's failed. So I was assuming that this would be the place to short from, and I was looking for it to at least touch up on this. Now, as a potential POI. Now, if I go on the daily, I did also mark this out as a potential POI also, which didn't give me an entry, so that didn't happen because then CPI did what it did. So I had this marked as a POI initially because I was like, it all stems from this CPB and this structure break. So I was like, okay, well, this is the last supply that I can see at least liquidated something. So I was initially interested in this one and I saw a reaction from it. So I was like, okay, maybe we won't get up to here. So I was prepared to short from here if possible. But CPI had other intentions given the fact that we had a demand chain all the way from here that was holding. So the hindsight in me should have been playing both sides more, but I didn't, so I just didn't take a trade. Furthermore, I can't trade CPI and FTMO, so I had to sit out anyway. And I wasn't willing to gamble on my personal account, so it is what it is. But well and truly, should have been hedging because if this didn't hold, then the natural place I would want to short from is where we are now. So there was enough room and range to get to here. So if I could, I should have accumulated some positions early to swing, but it is what it is. So we go down to the 4-hour time frame now. 4-hour time frame, we are in the zone that I was talking about. If we refine it, we get to here. This swept here. This is the POI that we care about, the last up move. So the last up move is a range, the last candle, whatever you want to say. We do have some imbalance here, so we might see us carry on going further. but keep in mind, like I said, I'm following the data closely. So in the context, this is why I say, there's a balance between data and analytics. So I have my POI and everything based on price action and etc. And then now I'm looking at the data analytics. So this week we started what, the 13th. So immediately I was looking at this week, I was like, if it hits the POI by day, and we're at day 13 when we're starting this week, I know this is the important week. This is the week that it's like, okay, it was a percentage chance up until here. Now is over 17 years. By this week, we should know where either situation, whether bullish or bearish, by day number 13, historically, if bearish, we should have seen the monthly high get printed in EU. And if it's bullish, the same thing, we should see the monthly low printed. So at that point, I'm saying to myself, okay, this week, historically, it's odd that we would see a monthly high get printed like this. Out of the last 17 years, it's not happened. So this threw me off from a statistical perspective. So it's either this is the monthly high. So let's mark that out. This is the way that I'm rationalizing it. Or we're bullish for the month and the monthly low is at the beginning of November, which was over here. Which in that case, well, I've already that the monthly move of me swinging this is long gone. Because it was all the way over there. And I didn't anticipate a bullish month early enough. So, tough shit for me. Missed out. So it's either the monthly low is this, and it's pretty much confirmed at this point, or this is the monthly high, and then this is liquidity to target. Because I'm still not happy with this being a thing in no man's land. I know one can argue, okay, it mitigated this demand, but I don't like it. So my opinion, this is the part of trading that will always be discretionary. How you mark your POIs, what your bias is, it will always be discretionary. You can only just improve with experience. But that's something that we're all, that's all part of the craft, and that's all, what we're all working on. But for me, when I see this, I just think dollar signs, I want the money. I'm still thinking we're going to go short. So I'm not getting distracted by this. I have my bias. It is what it is. If I get confirmation with this failing, then I'm looking to go short, take this out, take everything out. Because when I'm looking at the data also, if you look at this from a yearly perspective, so let's go to the monthly for a second. I'm just showing you my thought process here. This is why I think what I think. January started here, right? So let's get a divider line. January started here. This year is pretty rangy, but I'm not that convinced yet that this is a bullish year. Given the fact that if demand was in control, why did we break this, and this? Like, if it's to sweep liquidity, I mean, fair enough, but I don't believe that. Given the fact that we've got this fair value gap here, I would say that if we did want to go long, we'd want to accumulate some orders here before we'd go. Furthermore, for the fact that we broke all of this and we know statistically the low of the year is most likely to be in November and December, and we have this liquidity POI that we're at, if this gets respected, it makes sense that we would not only break November and October, but we'd conclude the yearly low in here in December, because that would make sense when trying to tell the story. Because we know December is most likely the month for the year, the yearly low, which we have over here. So this is why I think what I think. So depending on if this supply holds, will determine what I do. But that's my explanation for why I would potentially want to short from here, especially given the reaction that we're getting to what we know is a liquidity POI. So now we go down to the hourly time frame. Let's break down the opportunities that you could have got involved. So the week starts here. If you believed this was the legit POI, then you may be looking to short again from here. But given that Monday is here, you could long into it. Given the fact that you have potentially demand being respected, and you've got multiple supply failures. But in general, last week was very tough because you saw like it didn't really come to the POI that made sense to go long. And you only got, maybe this CPB over here to give you justification that, okay, supply is definitely not in control. Therefore, now you can look to go long and then play the chain. So like if we were to now look to enter on Monday or Tuesday this week, how would we have done it? So we mark out the chains. So we have the 1 hour chain that this stemmed from. This swept liquidity, like so. This is valid as a liquidity POI. Why? Because if you look at it, you identify the local sucker. To the left, what do you see? You see a supply chain. Let me make this bigger. No, I think it's too small for people. Can I just get some feedback on the sound check? Because I think my mic is being weird. Can you hear me okay? Okay, just making sure. So you have a supply chain. So if we take like this as the last up move, so this whole move, like so, it basically gets tapped here. And we're pretty efficient on the way down. I mean, then you get that, but I think from what I remember, there's a little wick in here or something. So let's say that this was the last part of your chain, like so, because you had this imbalance that needed to get filled. So really you need this to fail for you to get involved, which it does fail. So then on Monday, this is the last part of supply that you need to fail. So Friday, not interested in any trade. From this point, you had that as a liquidity sweep that swept these lows. So this is your last protected low that you can identify. So where is the arrow key? Where did I put this thing? Just find it here. So you mark this out. And that's your liquidity sweep. So this is your protected low. Then you're waiting for what? You're waiting for supply to fail. You have the main supply you want to fail is this one, but you've also got before that like a respected level here that gets broken. But ideally, you want this as your breaker because you can see it's part of a very efficient chain. So this is super aggressive, and it was on a Friday, so you probably wouldn't take this. This one is the one that you need to be able to say, I can go long. Then before that, what happened? If you're looking left, you could still think up until this point that we're looking to go short. Because at that point, we're forming lower lows, and you could anticipate this to be a lower high into this supply chain and this fair value gap, and to go down. But that doesn't happen. Instead, we break this, right? And relative to this wick, we have equal highs. So we have a liquidity zone now from here to target. So when looking at this from a PTLR perspective now, what are we looking for? So we now have a liquidity zone. So that's worrying. So if you're looking to go short, you're not going to really be that confident anymore seeing that, as well as the fact that you've just seen defined supply get fail. So at this point now, you're like, oh shit, okay. Well, this is the last protected low, and we've just seen another sweep here before this break. So this is your most recent protected low. So we mark that out again. Is this guy prior to that supply failure is what? What we know, what we identify as in the Project Lowdown community as the local sucker. So he's the victim that we are looking to take advantage of now in order to make money. So we carry on drawing our chain. So like so. And this is on the 15M at this point. So demand of 15M. And then we're interested in this POI. Why? Because there's no structural liquidity in this leg. So we need to play off the extreme. So if you want to be anal about it, you really want this last candle here. So this is where you're interested in trading from. So this is your P, this is your POI. So let's mark that out so it's nice and clear for everyone to see. There's no significant sweep in order to say that, okay, something needs to be mitigated. This is all efficient and there's nothing that was left taken. So this ends up being inducement to fuel the move up. So let's label that too, so it's nice and easy for everyone to understand. Inducement. So up until this point now, we have a liquidity POI, the local sucker. This is your protected low. Because they've manipulated price in order to entice people to get this guy to be the local sucker in the first place. So where's liquidity POI? Somewhere here. There we go. So now that we have this and we know where we want to trade from, so this is the POI or POI that we want to trade from. So that is P in PTLR. Now, what were we looking for? We need time. Let me finish the analysis first, and then I can answer questions at the end. So now we have P in PTLR, and what we're looking for now, as you know, is we need this to arrive at the right time. Yeah. So we know we have bullish bias given the fact that supply has failed and we have this breaker. So this breaker is your sign of supply chain failure. So we mark this out also. So now you have your bias. Supply chain failure. Up until that point, what do we have going in? We have one bearish day. So in terms of the consecutive candle analysis, it's still a 50-50 chance that today will be, we have one bearish day, then we have one bullish day. So it's a 50-50 coin flip as to what is going to happen on Monday. So you have no statistical reason to say, oh, shorts are stupid or longs are stupid. So just to explain that, like I said, one bearish day, one bullish day, consecutive candle analysis. Let me go and bring it. This is for GU, but it's basically the same thing. One consecutive candle, 50-50 chance. Yeah. So we have no reason statistically to think that it's either going to be bullish or bearish based on that. So you're going into this day with a neutral headspace, and all you're relying on is the price action in front of you and using it to tell the story. Which is why I said, you know, is a relationship between data analytics and price action. Here, there is no edge from a data analytics perspective yet, but we are looking at what price is telling us, and now we're going to use data to help us tell the story. Because now, just through price action alone, we know where we want to trade from, we know where the protected low is, and we know the POI now. So all we're looking for is a relationship between time and price to basically act as a bullshit detector for us to know that none of this is a POI to go long, meaning we're not looking to do this. Right? Because we know this is the POI that we want ideally, if we want to enter in a kill zone and we want to ensure that it's coming from a liquidity POI and a protected low, this makes the most sense. As well as like when we're looking at up until that point, what would you have had to say? So this is where you can use the data as a complement here. This Asia low is part of equal lows here, right? So if I drew this out a bit differently and I drew it like this, Asia is basically part of equal lows. So this isn't the criteria for Asia to be the low of the day, as we know. We needed to see it sweep liquidity. We needed to see it be part of a high time frame chain. We need to see it, dude, like, I'll address your questions after. Let me just finish. We need to see it, we need to see it sweep liquidity. We need to see it this appear in the first 3 hours. We need to see it ideally be part of a bigger range, because we know when Asia is this small, meaning, oh shit, wrong one. This range is 11.3 pips, right? Given the fact it's 11.3 pips. Ah shit, where are we? No, I'm on the wrong one. This one. Asia, 11.3 pips. The probability of it being swept both sides is anywhere between 70, well, it's basically 70%. So why would we, in this particular scenario, where we know there's liquidity below it, we know it doesn't fit our criteria because there's no sweep within it to say that this is a protected low, because we have equal lows here, multiple times at that, here, and here. So this definitely doesn't fit the criteria for it being Asia low of the day. Then the fact that we have the probability of it being swept both sides is 70%. So the only real trade that you would have possibly taken would have been you wanted to go short. But then when you see this supply, which has been tested here, fail to form the London high, yeah, you could probably take a low down liquidity trade short term to get to the other side, but is it worth it? Given the fact that you know that demand is in control, you'd have to cover the high. How much range do you have? Is it worth it for you? You can't even get to 2R before you hit the liquidity POI. This is why the short doesn't make sense in PTLR, because the last aspect of PTLR, which is range, isn't there. You can't even get to 2R, which is why this wouldn't be valid. So I'm addressing that because a lot of people will probably be wondering, why can't I take the short? So that would be why. Like, if you're not convinced, that you'd have to know that this would fail. You could take it as a hedge, because if it does fail at that point, that's how you'd want it to get in. So you can take it as a hedge, but are you confident in it? Don't know. But at least you know, as a hedge, you should be able to get to the other side. So 1R should be almost guaranteed. So at that point, you can at least know that you're going to be break even, if you wanted to play it that way. But you wouldn't be able to take this as a hedge until this failed anyway. So, I mean, it's a risky play, is what I'm trying to say. But yeah, back to the point. So you mark out your Asian range like so. We know you want to go long, and we know this low is supposed to be within 1 to 2 standard deviations of the Asian range. So we know it's at the first one. So we know if we wanted to lunch money it, we could. If we put a stop here, knowing that there's a 96% chance it won't take us out. If you wanted to lunch money this, well, it wouldn't make sense with PTLR, because you're not arriving at the POI at the right time. Because by the time it arrived at the POI, like if you said this was the POI, this would have been at 12. So this isn't valid either. You are now waiting for, if you're going long, the New York kill zone, which we clearly know in our data. Why is my... There we go. It's a bit weird. We know in our data, if you want to go long, this is the high probability hour to go long from. Does that make sense so far? Just to get some quick feedback in the chat to make sure I'm not going too fast. Okay, cool. So now it's about putting PTLR together, and more importantly, now you can see this aspect at work now. So there's multiple ways you could have got in on the Monday, and we're going to address all of them. So keep in mind 115M. So if you're someone who likes taking risk entries and ultimately doesn't have that much time for the charts, this would have been one of the criteria where lunch money would have helped you, because you already had the confirmation based on price action that this was a protected low, and all you're waiting for is PTLR. So you already knew this was your POI, and you're looking for it to arrive to form the low of the day in the New York kill zone, with that being a data confluence, given the fact that you just saw the table I showed you. So you would know that if it hits this POI at the right time, it's most likely the low of the day. Right? And that happens at 1 o'clock. So if you took this as a lunch money entry on the basis of what? Lunch money entry criteria is you need a liquidity raid. Well, liquidity is taken here as well as taken here. So if you mark this out like so, and said there was sell-side liquidity beneath it, that would be criteria for lunch money. Therefore, you would enter on the first standard deviation, like so, or you can wait for a candle close. Like I said, you have time. You're on the 15-minute time frame. However you want to enter is up to you, but you just know you have to cover this as your stop loss. Your stop loss must be here for a lunch money entry. Your stop loss is either going to be on the first one or the second one. If you're entering on the first one, it has to be on the second one. So whether you enter on a limit, whether you want more confirmation and you want to at least see a bullish candle and then you enter like this, it's up to you, but your stop loss must be right here. That is the rule. Mechanical rule, mechanical stop loss. It has to be here. Not, I want to get more R or whatever. Like, no. It has to be here. End of story, no debate. Then what you're looking to do? You trade towards the money. Now, what is the odds of this? So this happens at 1:30. So with regards to what the probabilities are at 1:30, you go to your table. Like so. So that's the 1 o'clock hour here. So the odds of this being the low of the day at this time is 85.22%. So you annotate it. So at the time of you taking this trade, the probability of identifying the low of the day is 85.22%. Which is pretty good odds for you. As long as your bias for the day is correct. Just leave it like that. Now, this is all in the 15M time frame. If you wanted a confirmation entry, meaning this, but upside down, then you need to go in the 5-minute time frame to be able to see it, and then you can still have got in. So let's do that. So entry 1, lunch money, and then you would look to target based on 11 pips, 5 standard deviations. So you would move this like so over here, and you go 1, 2, 3, 4, 5. But given the fact it's Monday, you know it's unlikely to be within. Monday is the smallest day of the week, so you should be going for 4, basically. So you'd end up here. But given the fact that if you're expecting weekly bias bullish and you're looking to hit the liquidity POI that I said, then you would not close everything anyway, because as I've said before, Mondays and Tuesdays, do not close everything. Leave a runner to do damage, because you know that the weekly high is most likely to be on a Thursday or a Friday. So you leave the runner to do damage because you've done all the hard work at this point. Do not choke the trade. So we've covered the lunch money entry. Let's cover the confirmation entry, because with the data, this then became super, super, super high probability, which I know Michael knows because he's the one who wanted me to do the table. So he knows exactly why this was a slam dunk setup, and I'm going to explain why too. So your POI is here. You know this is the liquidity POI. This is a slam dunk entry because you end up in this little bubble that we have here, getting your confirmations that you want, right? So, and the odds end up being better if you waited. So what do you need? If we're looking for, so what, ultimately we're looking for this, for upside down. So let me break it down. You're looking for a 5-minute market structure shift at the POI. So what that means is you want to see short-term supply fail for you to be able to answer the question, who is in control? You want to see supply fail in order for you to know that demand is in control. So you want this supply chain to fail. Let's make this a bit smaller. You want to see this supply chain to fail. So the last point of supply, so this reacts to this, makes a new low, reacts to this. So really you want your breaker to be right here. This is where it breaks, right there. That is your breaker. This is where we say supply is no longer in control because we've seen a supply chain failure. Like so. So at this point now, if you're looking left, like I said, but hold on. You also get your 5M chalk. Let me not skip over that. So 5M chalk, I'll write it like this for the people that are really, really smart money orientated. There's your chalk, right? 5M chalk, supply failure. So you've got both of these things now. So then at this point, you would enter covering this. So you put your fib like so, and then you enter, but you're taking this as an LOD reversal, low of day reversal, because you've identified this as the low of the day. So you need to cover this for this particular entry. So let me mark that out so it's clear. This is a LOD reversal setup. Low of day reversal setup. That's what that means, low of day. So you need to enter like so, and you need to cover the low. Now, by the time you take this entry, now look at the time. 2 o'clock, almost 3 o'clock, right? So the odds now of this being the low of the day are higher because you can rule out the 2 o'clock hour basically not being the low of the day, because 2 o'clock is almost finished and it hasn't taken this out. So by process of elimination now, you know the odds of this are now higher. What does that mean in terms of the numbers and the chart? So if you go to the same chart we just went on now, 2 o'clock is almost concluded. So now the odds are 91%. Once 2 o'clock is finished and we get to 3 o'clock, the odds will now jump to 95%. So now you know, when you get to the chart, by the time we're at 3, which is here, and you've already entered here, the odds of this are now 94.97%. So you know the odds of you being stopped out, if your bias is correct, is really, really low. So this is like a slam dunk trade at this point. So then you can hold this with confidence. Then also, where are your liquidity POIs? So if you said that, so you have this sweep of this short-term low before the move. So you can either take this as liquidity POI or you take the extreme. Up to you. Both are valid. Because if you look left, like I say, and how I define liquidity POIs, I always try and make the argument, okay, I'm trying to identify the local sucker. So if I could believe that someone could think that maybe this supply was intact up until here, then I can make the argument that someone could believe that we're going to do this. Given the fact that you saw this short-term, what retail will call support, fail, they would have been committed and maybe had self-stops to carry on taking the move short. So now they're in drawdown. So this guy now becomes the local sucker when this got swept. His retail, that's what a breakout retail trader would do this. They would have a sell stop here and they'd look to short it once this support fails. So this guy is in drawdown. So this guy needs to get mitigated, and this is your new protected low because this is manipulation to fool retail into thinking we can go short because they're banking on this resistance to hold and this support has now failed. That's a retail trader's confirmation trigger, which is a fake out, which is the SMC trader is like gold to us because then we know, okay, this is the footprint of manipulation which we're going to play off because now the manipulation to fuel this fake move down needs to be mitigated. So now your demand zone is here and it's part of a liquidity POI. So you're looking to go long from here. So the chain continues. Then now you've entered this trade is done, and you've got like a 4.4 pip stop loss out, like extended to 5 because of slippage reasons. And then here you have your continuation trade, right? Where you just simply use a fib from the low to the high like this, enter there, stop loss here, break even here. So you had all three entry models that we teach present themselves. You had the lunch money one that I covered at the beginning. You had the LOD reversal with 5M confirmation at the POI at the right time with all the data confluences in your favor to the point where New York became a 95% chance it would hold. And then you had your continuation trade with the FIB where you'd go break even right here, which I will mark out so it's clear for everyone to see. Do I have a break-even thing here? Yes, I do. Right? So you've got these two trades running. Now, data context. This is Monday. So we know it's Monday. So the probability of it being a bullish week and Monday, especially when you finally got this confirmation and we're trading towards the money like we wanted, we know that this is likely to be what? The weekly low. So now, knowing that, depending on how you decide to manage your positions, you can now go and say, okay, maybe I partial here. That's 6R on this trade. That's 4R on this trade. If you partial here, maybe, depending on where you are in the month, if you're up for the month, maybe you partial 50%. Because if you're up for the month and you're stage 2 risk, both of these, this trade is for sure a 2% trade, and this trade is maybe 1.5% based on the dynamic risk rules that we have, which I have over here, right? So you manage depending on where you are in the month and where you are, in what stage you are in dynamic risk. If you're in drawdown, you close majority of it, 75%, because the priority is capital protection. Therefore, you close majority of the volume to get yourself out of drawdown. If you're up for the month, do not choke the trade out. Maybe you close 50%. If you're at stage 3, maybe you close 25%. That part is discretionary and depends on how you want to manage your profit taking and your greed. But at the same time, if you think that the POI is far away and you're risking 2% risk, I mean, closing 50% still leaves you a 1% runner. That's decent. That's what I typically do when I'm at stage 3. So, like I was saying, so depending on where you are for the month, you determine how you partial on this day. Because at the end of the day, you're not holding full volume and going for the moon. You try and pay yourself because then you end up getting free shots to be able to scale in later. So you can take a free shot at CPI. But you've already got this one protected. So at least if you take a free shot at CPI, even if you took a loss, you're not going to be negative for the week. Now, if you think this is a weekly low, given the data we have, we can figure out and forecast where the weekly high is going to be if we're bullish buyers. So weekly low identified. Now we need to know what the weekly range is for November. So we go to the data, like so, this one. November. And then we look for what is the November average weekly range. It's 246. These two anomalies cancel themselves out, and then the rest is fairly consistent. So I'm confident with this number. So this is the number I'm going to use, right? So 246. So I'm going to mark this out, and I'm going to use it as a reference point for me to be able to forecast where the weekly high. Oh, sorry, my bad. Thank you. Thank you. 190, sorry. Same principle. These two cancel themselves out. The rest is fairly consistent. So I'm happy with the 190 number. So 190 is what we would use to do as a target. Keeping in mind, we know CP is CPI week. So CPI week will naturally give us more volume than usual. So 190 is actually a conservative target, given the fact this is a CPI week of big significance. But regardless, this is the process that we do every week. So 190 gives us a rough gauge of where we could expect. So we mark it out. So the price target, and you look for where 190 is. Because at the end of the day, we just want to get paid. We're not trying to get it to the pit. We just want to get a suitable weekly target. So 190 is all the way up here. So then we look left and look at the price action to see, does the story make sense? So let's go to like a 1 hour time frame or something. So 190 is here. And where was the POI that I said I wanted to trade from? This region here, but we have this manipulation wick here. So I could say, okay, this makes sense because this is obviously a liquidity POI. Okay, this makes sense to probably get out. And it's bang on 190. So yeah, that makes sense. Cool. So then that would be your game plan. And you have that as a potential POI to go short from. So it lines with the story. So now, back to our example, now that you know 190 is the weekly target, and you partialed on this day, however you wanted to, your target for the week is all the way up here. Because you're trying to get the weekly move. Thanks. Let me go small. So that trade is a 30-yard trade. And this trade, oh boy, this is a big one. Michael, please tell me you held this. At least to here. $37R, $30R. So this was a $67R move. That was, yeah, okay. We're not going to talk about it. Okay. Either way, great trade, bro. But yeah, this was a 67R move that is a playbook move. Like we've talked, you've seen me do breakdowns on this move over and over again. It's the same shit over and over and over again. So like we knew, as long as you mark out your POIs correctly and let data tell the story, you know where to get in, you know when to get in, you know where to get out on a weekly basis, and you know when to get out. The only thing that was the major thing that threw everybody off was nobody was anticipating to hit the weekly move by Tuesday. But given the fact that CPI, it makes sense. So that's something that we all, you get with experience, and we all learn, through trading. Like, okay, when CPI is coming, anything can happen. You can get the weekly range done in a day. We've seen it, we experienced it. This leads me straight onto the point of the playbook. If you have a playbook, you can see these moves more often. And you literally make a playbook, like you document this now, and you say, okay, that's one of the plays for CPI. Then you look at the rest of the CPI and see, do they follow the same sort of structure? Do they form the POI in London? Do they do all of these things? Do I see my confirmation entry? All these, break down the trade mechanically. Because when you're looking at the data, so we've just seen CPI form the low of the day in London, right? So that's like a data footprint as to what we would expect or associate with CPI. Then you would, use the data as well as, go back and see previous CPIs to see, okay, is this something that is consistent, like statistically consistent for me to form a mechanical execution model around it, i.e. a play for my playbook. This is why after building my playbook and, doing things like this, that's why I looked into the red folder news data and I looked at CPI and I would be like, okay, is there edge around a certain session associated with CPI or not? Because if there is, then I know that I can take these with confidence. If I know that, let's say, New York has the potential to give me issues and I should wait for the setup in New York, like, sorry, in this case we did, New York was the low, then I know that, okay, maybe I shouldn't rely on London because New York has a significant participation when bullish of forming the low of the day. So this aligns with the trade that Michael took in the community where you would wait for New York because it's likely that New York could be the low of the day. So you wouldn't be, if you didn't see your confirmation in line with the price action in London, then skip London because you know it's most likely to be in New York. So this is an example of when you're using price, action, and analytics together. You're not saying that, okay, the data says this, therefore it must be this. Like you're using it to tell the story, not write the story. Can't believe it's already 9:20. It's completely lost the track of time here. But I hope you guys have got value out of at least me covering this in detail and not rushing it. Right, so that would cover the Monday trade in detail because you had all three entry models. You had lunch money, you had LOD reversal, and you had low down continuation, which was this one. All mechanical, stop losses defined, etc., etc. So then the question now becomes, okay, what the hell do you do on the scary day that blows accounts, right? So this is my advice. Me personally, unless I'm up for the month and comfortable, or if you played this properly and you partialed correctly to the point where you had a couple free shots, let's say you secured 25% on both of these trades because they both went to 4R. So you've secured 2R up until this point and you've got 75% runners. So in regards to the maths, if this is 67%, where's my calculator? If this is 67R, 67 times 0.75. Oh shit, that's the wrong button. 67 times 0.75. So you got a runner that's potentially doing 50R damage. From you just literally just doing what I said based on the data, take your partial, leave it alone. Don't do shit. 50R. Think about that. And that's at 1% risk. Imagine if this was dynamic risk. Well, this one is a 2% dynamic risk trade. So realistically, this could be anywhere from 50R to 100R from you just taking your partial and going to bed and coming back after CPI. Like, don't do anything. Don't overmanage it. Don't do anything stupid. Like, don't let, your emotions get to you, anything. Just let it go. Trust the data. Because you can see the data plays out week after week after week. I mean, over 16 years it plays out, right? So the question now becomes, all right, how do you manage CPI? So if you're on a funded account, you don't touch CPI. Leave it alone. It's restricted, no trade. If you're on a personal account and you're up for the month, then, and you've already banked money here, it's a free trade, free roll of the dice, free gamble, whatever you want to call it, you can do it. This wick isn't legit on brokers. So I'm not going to use this as an entry because it's not actually valid. Because it didn't appear on my broker, and I know it didn't appear on a lot of brokers. From what I hear, this was a trading view thing, unless someone can correct me if I'm wrong. But I didn't see this on my broker, so I don't think this is valid. So in the ideal world, you would have wanted to see a low of the day, ideally print in Asia, like the first 3 hours. You wouldn't want to see it print at 5:30 because if you look at the data, there's no real edge here. However, this is why I say, okay, base things on price action. So the only thing that we had to go off here is we had a structure break. That's a break of structures to the upside. So demand is still in control. That is still a liquidity POI, technically speaking, relative to the structure break. So all I would say is your entry is you carry on taking any structure break you take, it's just continuation. So that's a structure break, that's a structure break. So at the end of the day, a fib will work because if it's a continuation, it's a fib, therefore that's your entry if you really wanted to take it. And then if that CPI candle was legit, it would be the same principle. But I would still go from the extreme. I would not go from this because this doesn't identify to me as a local sucker. I'm not convinced of going short here because of this candle. And I don't think anyone is. So for me, this doesn't meet my criteria for a local sucker. Yeah, it does work, but it doesn't meet my criteria. I would want to draw the fib from here because I can at least say from this aspect, somebody could be convinced when all this is breaking that we're going short. Nobody's convinced we're going short from this. That may sound subjective or whatever, but at the end of the day, like I'm just telling you like how I would play it. So either that fib or this fib. So that's entry one. If this was legit, which it's not, from what I know, and that's entry two. You just take the continuation and you go with order flow. And then the same principle. Where's your target? Same place. Here, because you're going for the weekly move. So, in conclusion, for the week, what did you have? You had 67R, 67, oh, well, that's actually 68R. 68R plus 45. Where's my calculator? Brain is tired. I don't want to do mental maths. 68 plus 45 plus, what's the last one? 19. You had an 132R week. All with mechanical entries. No subjectivity in these entries. They are mechanical. And you had data-driven edge behind all of them. The only thing that was questionable, which is why I said is a fine line between price and data analytics, is ideally you would not have wanted this low of the day in Asia to appear at 530. Because when looking at the data, 530 is not really a kill zone hour or even like a hotspot hour for EU. Bullish 530. Nope. So you're not expecting to see it here. That's the only aspect of that trade I didn't like. But this is why, like I said, you have to, use it, but it's not zero, it's 0.87%. So yeah, it's low probability, but it's not impossible. And the odds of it up until that point is 39%. But by the time you take the trade, what's the time? It's 9 o'clock. So the odds of that being the low of the day at 9 o'clock, it's 66. It's more than a coin flip. So it's not horrible odds, but it's not ideal because, like I said, it's not printing in the hour that you would have expected. If it happened maybe at 6 in the morning, you could probably take it with more conviction. But 5:30, it's tough, right? But that was your only opportunity. If you missed that, I don't think this actually exists. You wouldn't be able to get in unless you would have said, okay, enter here, and then you have a giant ass stop loss of 25 pips, which, to be fair, isn't crazy. Given the fact that if you're trying to play the weekly move with a 25 pip stop, up until that point where it's like 1 o'clock, then the odds of that being the low of the day are what? 1 o'clock, 85%. But at the same time, the thing that would concern me also, so like let's be real here. If you saw this in a weird hour, and then you don't really see a significant demand chain here, who's to say that we wouldn't get some manipulation here, and then New York kill zone will form the low, and then it would do this bullshit. This is why I wasn't comfortable taking this, because I've seen EU do that before. and then given the CPI data of us most likely looking for it to be in, or it could potentially be in New York Hill Zone, which we have over here, like I said, bullish, probability of it being in New York, a lot higher than Asia over the last however many years. So there's two things that make it low probability for me to be willing to take this Asia low seriously. Because the one, not only is it the lowest probability session to see it, but two, it's not coming from a nice place in terms of PTLR. So for me, honestly speaking, this isn't valid. Because I am not convinced, there's no statistics in favor of this. So I just sat out. Because what I was expecting, honestly, which is what I marked out in the EOD, I was expecting a New York to New York continuation and something like this. Because then it would have aligned with, okay, it's in New York. And ideally, I would have wanted to see, if I'm super lucky, which I probably wouldn't be, I would have wanted to see a confirmation entry here to be super sure and get in. This was too high risk for me, so that's why I didn't do it. Because how do I know that this isn't just inducement for this move? Because like I said, there's no session data backing up CPI having an Asia low. It's the lowest probability session that you're going to see it. Fact. So I just didn't take it. So unless you got in early like Michael, the Tuesday CPI trade was low probability. I wouldn't recommend doing it. It was unless you took the Monday trade, you partialed, and then you had a free shot. It wasn't worth the gamble. The only thing I could have possibly explored if I was going to take a risk on CPI was I might have, if I anticipated that potentially Asia could get swept, then this would be an example of where I would use lunch money. But then also keep in mind, another thing that threw off everything was look how small this range is. 9.4 pips. So there was like an 80% chance both sides will get swept, which added to the narrative of what I was saying. I was expecting this to happen. So there's so many reasons why this was low probability, but it worked out. So when that happens, you take a calculated decision. I'm glad I followed my plan and I didn't take the trade, because had I got stopped out by FOMOing, I would have been pissed, because there's a lot of stuff saying that it was a dumb trade to take. So just because it works out doesn't mean it was high probability. It was still a low probability trade based on the price action and the statistics. Just my opinion. But if you caught it, good job. But if you missed and it slipped you to get you into your entry and you had like one of these 2 pip stop losses, you blew your account. Good job. So up to you. I know people that got slipped 30 pips on CPI, tried to short it with 2 pip stop losses and blew their account like you can't believe on Twitter and some of these funding discords. So it's up to you to determine what risk you want to take at the end of the day. But that recaps the main part of the week. Is it's just been rangy. It's not really worth covering whatever the hell this bullshit is. So is that okay? I think it's, yeah. It's 9:30, so we can only really have time for some Q&A. Let's see what's there, and then we'll conclude. Okay, Mustafa says, struggling to see how you would use the risk reward fib. Right. Okay, so let's do this real quick. So how does the risk reward fib work? All right, let's just do this as an example. Right. So let's just say I am Rain Man and I just said, okay, I wanted to enter right here with a limit order, blah, 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 right? Demand 15, whatever. So my entry is here because I am Rain Man and I catch all moves in hindsight because I am the best. And I want to hit 10R. Boom. So let's do that. 10Rs here, right? More or less. So we get our risk reward tool out. So we put from here, change it to risk reward. Where is it? Here. So let me do that again, make it clearer. fib, go from the point where you want to enter, drag it until the red line covers your stop loss. There you go. That's how you draw it. Then each one of these is an R multiple. So this is 1R, 2R, and so on. And that's 10R. And then those are the prices associated with that R multiple. That's how you draw the risk reward fib. So I hope that answers your question, Mustafa. So that covers that. Joe asks, is the Asian range liquidation a must-have criteria for lunch money? No, it's not, but it makes most sense when it is, and I'll explain. So, I need to find a lunch money example now. Right. So, I didn't even check. We have a Q&A section in here, do we? Do we have any Q&A? No one has any questions in here. Okay, so I just need to answer this one and Fear's one real quick, and then we're done. All right. So hold on. What did Jewel ask? Jewel asked. Okay, that's a personal question, so I'll answer that separately. All right, let me answer Joe's question. All right, let's talk about lunch money. All right. Let's remove everything and make things clear for everyone to see. All right, let's do a lunch money 101, right? What really is lunch money? Why did I even come up with this thing? So lunch money is adaptation of what ICT teaches as total soup, but for me, it didn't have enough edge, right? So okay, so let me explain the difference between the two, first of all. Like, let me just do a quick 10-minute tutorial or so on lunch money. So it's like easy for everyone to understand. So lunch money, as defined over here, is what? It's a liquidity rate. So it's where it's a calculated risk entry where you're expecting to see a sweep of liquidity, but you're not going to get a confirmation entry to get in, right? It's just going to happen and then it's just going to go like this. Like by the time you get your confirmation, it's gone. Like if you're waiting for a breaker like here, by the time you get in short, you're now left with a 25 pip stop loss with barely any range, right? So lunch money is in the event where you know you have a liquidity rate, like so, where you know this is likely to get swept, but we are, let's say, but you know what the bias is, meaning you know the high time frame bias is bearish, and you want to potentially get down to maybe, and you already said that, okay, based on price action, if you are going to long in the long term, you want to long from somewhere here, for example. So with that being said, you see this liquidity, but you're still expecting us to travel to go to this point. So then you're saying, okay, I want to enter with a lunch money setup because you know that the probability of finding the high and low of the day, the high of the day should be within one standard deviation 80% of the time and two standard deviations 96% of the time. So if you're expecting this to get run, you know that you can put your stop loss here and know that if your bias is correct, 96% of the time you'll be correct. Sorry, 80% of the time you'll be correct here. 96% of the time you'll be correct if you put it here. Why lunch money is powerful is because it's almost a guaranteed 2R setup. So let me explain. So you put your stop loss here, and then your target for lunch money really is this, minimum. And then your stretch targets are based on the standard deviations of the Asian range. Then maybe you can say it's either 2 or 3 or 4 standard deviations. But your guaranteed target is always 2. And let me explain why based on the maths, right? So you can see here that the range needed for a lunch money to give you 2R complete is 3 standard deviations, meaning that as long as the Asian range is under a third of the day, you're almost guaranteed always to get 3 standard deviations. So when you look at the table, this is how I knew it worked. Majority of these days, so if I was to add this up, do I have this file still? Yeah, quick look. Yeah, but it works the same, Archer. It works the same. Okay. We'll do some mental arithmetic. Okay, fuck it. We'll do some mental arithmetic because I don't know where the file is at this present moment in time. But I will do the maths in front of everyone here. So let's get EU and GU because, like I said, lunch money works for both. So, EU's okay, cool. Let's have them next to each other because I want to address this point once and for all. Because I want you to understand the maths behind lunch money and why it works. That's GU. Where did I just put EU? Okay, whatever. Let's just do GU's here. Did I just close it? Or am I being blind? GU here, EU there. Okay, there it is. Cool. Right. EU, GU. Right. Okay, let's do it. Okay, let's do EU first. So the majority of these days are under a third. So from here, all of this is valid in terms of what I'm saying, 2 hours guaranteed. So anything under 33.3% is valid. So I need to add up everything from here onwards. So let's do the maths. So what percentage of total days possible is 2 hour lunch money? Provided that you get a sweep of some kind, right? So let's do it. So 10.6 plus that, well, just roughly 14 plus 18.5 plus 20.23 plus 12.2 plus 3.2 or whatever, right? 78% of all days that you do a lunch money, you'll get 2R. Right? That's why it's a slam dunk 2R trade setup. And this same number, this is EU. I go to GU. What percentage of days are under 33? More or less from here. So if I go from 7 onwards, I'll do the same exercise again. Right? Pretty much anything under 33% is guaranteed. Yeah, exactly. So anything, so realistically from this one, if you want to be cheeky, let's just use this one. So let's say, because it's almost going to be it. So anything from, let's say 35, let's just do it, right? So I've already proven 80% of the time it will work for EU. Let me do the same thing for GU now. So 7.26 plus 10.28 plus 13.2 plus 17.5 plus 17 again plus 13.5 plus 5.23 plus 0.62. 84, 85%, right? So knowing this, 2R is almost guaranteed. So I just wanted to make my life easy. So if I'm lazy and I'm just like, I want to enter and I just want to get a guaranteed target, automate everything, set it, set TP, and I know it'll get hit. Even on shit days like this. That's the liquidity rate. So let's draw it again. I want you to see this with your own eyes so you can see what I see. That's the liquidity rate. Enter like this. Enter like that. Take your 2R TP and you're done. This one, I mean, figuring out your bias would be difficult, but you could do it either way. Okay, so if you enter short, you would need, where would your liquidity rate need to be? Ideally, you want this to get rated. You'd have been stopped out. If you covered it slightly, you'd have been fine. But do you get to a 2R point, which is the main thing I'm trying to address here? Yes, you do. If you took it the other way and you longed it, and you entered on the first standard deviation, and you said that what this was your liquidity rate, like here or wherever, meaning that you thought that this was going to be an inducement, because like I said, you still PTLR is still relevant here. You can't just go and put a lunch money in random fucking places and say, okay, lunch money. Like, no. What is the order flow? What is the market direction? So we're still looking to go long. We're at the first standard deviation, so we know what lunch money trade, like I covered in the call. You cover this, and then you want to go for 2R, you're going to get to 2R. You got 2R here guaranteed. You want to stretch and take the high, then you go to 3R. But you know it's a guaranteed 2R setup. And it works best when you see Asia get swept, to answer Joe's question, because the Asia acts as the liquidity sweep, which is the criteria for it in the first place. So like even with this one, this is a Monday, so this is the reason why it didn't work out. But regardless, if you said this was the sweep, you ideally want this to get swept or just Asia to get swept in general. You put your stop here, you aim for 2R. Doesn't happen on the day, but you get it the second day. Or you can put your limit like this and so on. So I hope that answers your question, Joe. The main criteria is you want to see a sweep. The reason why it works more so for Asia sweeps is because Asia being swept acts as the liquidity rate criteria. But obviously, like everything, there are anomalies. Like this one, like what could you do? Ultimately, you mark out your POI and you wait for PTLR to trade this. You're not going to trade this on a lunch money setup because where is the POI you're looking to trade from? Unless you have confidence in this, but then at the same time, okay, you take it out. And this is this is the 4% criteria that I told you about. So this, when I say 96% of the time it won't get to this, this is the 4% that it happens. It's rare. No worries, Keys. Catch you in a bit. But as you can see, it works pretty effectively a lot of the time, right? Here, same thing, lunch money, enter that. That's your liquidity rate. Enter like this, stop loss here. Go for your 2R target, boom, you're out. Go for 3R, boom, you're out. If you see this is, okay, 10 pip range, 5 standard deviations, okay. Mark this out like this. 1, 2, 3, 4, 5, TP, you're out. Yeah? That covers that. And we are out of time. So anything else we are going to have to cover next week because we're already over. But I hope that was useful in terms of covering CPI, what you could have done, showcasing some of the new data that's going to be live on the site, how to use it. And yeah, I hope everyone enjoyed the call. Hey, cool. Well, if there are any unanswered questions from today, please put them into the questions channel and then we'll address them next week. But the main thing I want to cover next week, which I didn't get any time to do this week, is I want to cover the playbook. Because the playbook is arguably one of the most important things you need to have as a trader. So we need to prioritize covering that. But yeah, that concludes the call. Thank you guys for attending. It will be uploaded either by tomorrow or the day after. Depends on how quickly it renders, and I can encrypt it. So yeah, cool. Cheers, guys, and we'll catch you again next week. Bye.